Gurmeet Chadha as well as Aditya Arora joining us on the show to talk to us about what exactly should you be doing in this market. Gurmeet, while the headline index this week is down only 0.5%, it's the small cap index which is down almost 4%, mid cap index is down 2.5%, and if you look at the portfolio level, a lot of stocks are down anywhere between 10 to 30, 40%. I know after having those multi-bagger kind of returns, 10-30% pills in comparison, but how should one navigate through this pain right now?
Hi Anisha, and I think if you see, always the second leg of the correction is the most brutal one because it tends to erode small and mid caps by double digit in a matter of few days, and even some of the stocks which have done well, but because the valuations became very high, have corrected even post earnings. So it's basically the valuations, because the entire index was more than 30 times. And if you report 15-20% earning and stock is trading 50, 60, 70 times, I think the market tends to reset the expectation, and that what has happened there. My sense is that the FI sell-off has to abate a little bit. It's almost been like 5,000 crores on it. It's like a systematic withdrawal plan. You are seeing since September. I was doing some maths from 27th of September till now. They pulled out almost 3.5 lakh crores now. That's a lot of money, almost 35-40 billion dollars in secondary market. Of course, let me qualify that, because they've also invested in primary market. Usually you see this kind of outflows during a very large event. This time it's been more because of expectations around what's happening in US and rising bond yields. And if US cuts corporate taxes, which we'll get to know, the market is trying to basically flow there. But at some point of time, mean reversion will happen. Whether it happens now or another 5-10% correction from here, that remains to be seen. So I think constructively you should, if you are a long-term investor, you should deploy, but don't overpay. I think the only lesson here is just don't focus on the price fall. If the price fall is not brought a stock closer to where its earning multiple is, I think that's the time to get into it.
Okay, but have you recently added any stock or any theme which you think is now in the buy zone after the correction?
Oh yeah, a lot of them now. We always say you should never waste a correction, especially if it's a sharp one. So I think for the first time, probably we will see if January is going how it's going, 4 consecutive months of Nifty giving negative returns. It's not happened for a very long time. So we are adding some banks. I think the entire bank Nifty is now 13 times earnings, less than 2 price to book. It's significantly lower 10-year median. I think it's again largely because of the over ownership FIs had in banks. Also, the banks are a reflection of the economy. So as economic growth slightly slows down, bank gets hit the first, and vice versa. When things will pick up, you will see banks leading the rally. So that's something we are adding. We've added some auto OEMs where the valuations are reasonable and they're doing well, like M&M, for example. Some of the auto component players like Uno Minda, like Sandhar Technology. We've added some names there. Well, we've added some recycling names in this correction because we believe a lot of these opportunities are very structural, whether it is water treatment, whether it is plastics, whether it is lead. So we've added some more names there, including Ganesha Ecosphere, Gravita, Vatek Babag. We are adding some railway names now after a 30, 40, 50% correction there. We expect the railway capex to actually hold during the budget. So these are the few things we are adding on dips, and will probably continue to do so over the next few weeks.
List there, and an exhaustive one at that, Gurmeet. But tell me, what about the large cap bias? I see a whole lot of mid caps in there.
No, so it's not a question of market cap. It's a question of the size of the opportunity. So I can see Reliance on the screen. I think that's also been very reasonable. It's corrected quite a bit. We have added ICICI Bank in the portfolio. I think that's one bank which probably has taken the hit despite performance being industry leading. Axis Bank is one times price to book. Has not traded in that range for a very long time. So valuations are really, really reasonable, but you have to wait for the broader economic indicators to pick up because bank credit growth is likely to be early double digit. Liquidity conditions are tight. So we hope that, maybe by May or June, you will see things easing both on liquidity as well as interest rates and obviously economic activity. I think budget is a key trigger here. And as I said, some of the IT names also we have added. I think they're sitting on cash. it's some of the safe havens you can look at, especially in times like this. And if US does corporate tax cut, discretionary spending will pick up. So we added that, and some pharma names like today, for example, Mankind Pharma has corrected a little bit post earnings. So we're adding even large caps on dips. It's more a multi cap approach.
Quite interesting there. Aditya, what are you seeing, or rather, where is it that you're seeing strength and have a positive bias in the market right now?
Very good afternoon to you and to everyone. Look, I think a lot of FMCG counters are showing clear-cut strength after Hindustan Unilever delivered its result. This stock is clearly outperforming the market, and even when Nifty mid cap, small cap, and large caps are correcting, this stock is clearly doing well. So I think most of the correction is done, worst is behind us, and we have already seen very good correction in this counter from heights of almost 3,000 odd levels to 2,370. So here the stock looks pretty steady and strong. So this one is a good buy as per me. And if I talk about the levels, then it's a good buy at 2,370. 2,285 is the stop loss and 2,425 is the target. So overall FMCG pack looks good. And I like another stock from this basket, that is Britannia. This is also doing well after forming a rounding base. This is breaking out of its resistance zone and congestion. So there's a good upside over here as well. This is a buy at 5,100. 4,980 is the stop loss and target is 5,220.
Taken numbers at the bottom of the screen as far as Shriram Finance is concerned, and looks like a very solid beat on the bottom line. The actual figure has come in closer to 3,500. We were penciling in a number of just around 2,700. I'm guessing the other income, or there might have been a bit of an adjustment that would have led to it, because the profitability is looking much higher. The NII figure, the first number that I looked at, was pretty much in line with expectations, slightly muted actually at that. So we'll have to see actually what really worked out well and what led to this slight miss on the NII, and where exactly do the NIM settle. So we'll wait by to kind of give a verdict as far as Shriram is concerned, but the street is giving the verdict for now. It's taken a bit of a bounce back from the lows. We'll wait by for more data on that. But Aditya, anything on the charts of Shriram Finance that you want to call out?
Yeah, so when we compare chart of Shriram Finance, then it's pretty much outperforming the market when a lot of finance counters are, facing good beating on the charts. This one is pretty stable. So we'll follow level-based approach over here. The stock is currently trading at 535. We can see a breakout above 555. Over there, it would be a buy. Stop loss should be maintained at 520 and target should be maintained at 565 to 590.
Okay, so that's the view coming in as far as Shriram Finance is concerned. But let me take it across to Naresh as well. Naresh, even the other NBFC heavyweights, Bajaj Twins, for instance, housing finance companies and all of that, they have fallen out of favor. Anything within the NBFC or the gold financier or vehicle financier, anything that you like at this point of time from this vertical?
So gold financer names look the best. Two parts to it. One is gold has hit a new all-time high in INR basis, just 1% away. Even in USD basis, that generally augurs well for them. And in that case, you've seen even Manappuram come out of that RBI ban, etc. The stock has started moving up. And Muthoot Finance continues to lead. That is the stock which is just 2 to 5% away from an all-time high. So that is the strength space, and would be looking out for Bajaj Finance because that has started sustaining even in the market correction. So going forward, it could become a buy on dips.
Point taken. Just wanted to highlight the additional details that we're getting on Shriram Finance. There is an exceptional item as we feared of almost 1,650 crore, and that's why that's a big beat on the bottom line. If you strip that away, then the number looks a little shy of what the street was expecting, and that's the reason the stock has turned into the red at the moment. The asset quality has worsened, as was the case with a lot of financials this quarter. So GNPA ratio has come in at 5.38%. That compares with 5.32 last quarter. The net NPA ratio has come in at 2.68 versus 2.64. So that's the latest as far as the the numbers from Shriram Finance is concerned. The capital adequacy ratio is actually quite decent, 21% this time on a standalone basis versus 20.16%, and the liquidity coverage and all of that is quite okay. I think it's the miss coming in on the NII bit, and of course that percolating to the miss coming in on the adjusted profitability, and that's the reason that stock might be a bit lower. Let's pull up the stock of Shriram Finance and see what it's doing at the moment. Yes, so after that sudden bounce that we had seen, it's now cooling off because that exceptional is getting factored in by the street. But since we're talking about earnings and financials, let me take it across to Gaurav to get a better understanding what we should expect from ICICI Bank come tomorrow.
Well, yes, in an environment where loan book growth and asset quality is one of the concerns for banks, ICICI Bank is all set to come up with a good set of numbers as per consensus. What they're saying is that the loan book growth can be in the tune of around 14%, which is higher than industry growth, and at the same time deposit growth can be in the tune of 16%, once again higher than the industry growth. And as a result, when we talk about net interest income, we may see a growth of around 10%. Now, net interest income may not grow at a tune with loan book growth because of the higher cost of deposit, and that is the reason why when we talk about net interest margins also, Street is expecting some kind of moderation of 4 basis points in net interest margins in this quarter. But other than that, fee income is likely to be strong, and that is the reason PPOP can grow at a rate of around 12%. Lastly, when we talk about profitability, it is expected to grow somewhere in the range of 10% on a year-on-year basis because of the provisions in this quarter, because let's not forget that Q3 is usually weak in terms of agri loans, and that is the reason KCC loans is something that we will need to be watched out for in ICICI Bank. Other than that, when we talk about some other aspects, asset quality is not going to be one of the concerning areas for ICICI Bank as per consensus, because the bank has already maintained one of the strong asset qualities across the industry, and with this they will also come up with one of the strong ROAs as per consensus. Lastly, things to watch out, we will be watching out on deposit growth, any kind of commentary on the growth from the bank and management, how they are anticipating the growth, any kind of commentary on net interest margin, and lastly, overall business outlook is also something that we will be watching out for from the management. But all in all, when it comes to numbers, good set of number is what we are expecting from ICICI Bank in third quarter.
Okay, so that's about ICICI Bank, but more details coming in as far as Shriram Finance is concerned. The net interest margin ratio has come in at 8.48%, which is lower than 8.74% that we had seen last quarter. And this trend of declining, a NIM margin has been there for at least last 4 quarters. That's what I can see, because Q3 FY24, this number was 8.99%. From there, it has been consistently coming lower. And right now, we have a number coming in sub 8.5%. The cost to income ratio, on the other hand, has actually gone up. So the OPEX cost, etc., has been going up for the sector. 28.59% is where the cost to income ratio has come in at, versus 27.74, 27.95, I beg your pardon, which was the last quarter. In terms of the book value, that of course has got inflated to 292 versus 277. Interest coverage is steady, a little lower at 2.24%, but the return on asset has actually improved. So one needs to really watch out for that. Return on asset excluding the exceptional item has come off to 2.88% versus 3.06%. So looks like there's a bit of a declining trend as far as the performance is concerned, in terms of asset quality, in terms of NIMs, in terms of the cost treatment, in terms of return on assets. All of those have actually taken a bit of a deterioration. Yes, the street was expecting a deterioration because the sector has been going through that churn. But for now, that stock is now down about 1%. I know you track Bajaj Finance very closely, Gurmeet, but do you track Shriram Finance as well? And any initial word on the overall NBFC space?
No, I think it's expected that NBFCs will struggle because they get impacted more when there is a fight for deposits, because unlike banks, they don't have any access to CASA, and cost of funds have been a bit of a worry, and so has been the high yielding portfolios for NBFCs, which is personal loan and other stuff, which RBI is also highlighting. So you really need to do the balancing act right now. You need to be more conservative in times like this, when growth is slowing down, there is stress building up in short term personal loans. So I think Bajaj did a good job. See, there is a point up to which the stock will, stop reacting to negative news. Since Bajaj Finance, for example, our 3-year returns are zilch, right? And the EPS growth has been more than 50-60%. Again, drawing an analogy, even HUL, for example, the results have been poor. So has been the stock performance for last 3 years. So there's a point up to which, the negative news gets in the price. And that's why you saw the jump in the HUL prices, because again, hasn't done anything in the entire, rally which we saw last 2-3 years. So I think incrementally there should be some improvement, but the key trigger has to be that liquidity conditions have to ease, growth has to slightly pick up, and there has to be a rate cut. And then probably NBFCs may, in the short term, may outperform banks. But if you are an investor who's more moderate and let's say want to be conservative, I think the banks are the way to go. As I said, entire bank nifty is available at 13 P. You're getting a lot of banks at one price to book. You have Axis and Federal at one price to book. You have HDFC and ICICI at about 2.2, 2.3 times. It's very reasonable.
Okay, that's the word coming in right now on what to do with the financial pack. But Naresh, does it seem like these stocks make for a good buy? And within private banks, if one has to take that one call, which stock would you recommend?
So the name would be Kotak because that has the return which has been zero for almost 5 years now. The stock saw a bit of an uptick after numbers. The stock has gone nowhere. And it has not been over-owned in the last 2-3 years. HDFC Bank, at least there is a lot of ownership, which is not the case with Kotak Bank. So Kotak would be the name in the large cap banking space. And overall, whenever the market trend changes and post-budget, if we see a positive impact, banks could be leading going forward.
Let's see whether the banks lead and the NBFCs languish or not. But for Shriram Finance, we have seen a bit of a deterioration. But Varun, is the deterioration on expected lines or is it worse than what we were factoring in?
If you look at the overall NPS number, the deterioration is slightly there, but it's not like other NBFCs where you have seen the NPS increasing, by a big number. If you look at NPA over here, 5.38% versus 5.32%, that's a manageable thing. Also in the NNPA, it's 2.68% versus 2.64%. So the deterioration is not much, it is on expected line. If you look at the NII numbers, though there is a slight miss on NII numbers, but if you look at the profitability, it has actually come better than estimate. We were expecting the profits to come by around 2625 crores, it has come around 3570 crores. There is an exceptional gain of the stake sale that the company has done in Shriram Housing Finance. But yes, that was expected, and analysts on the street were actually factoring in that number, and that's the reason they were anticipating a number of 2625. So actually the profit is better than estimate. Definitely the PPOP, if you look at that figure, we were expecting around 4151 crores. So that is a slight miss of around 4085 crores. But yes, it is almost as per expectation. So if you look at overall operational performance, yes, it is, better than estimate. No doubt the NII have shown a little bit decline. The NPS, there is a slight, increase, but I don't think so. Looking at other companies, when you compare it with other financial companies, this type of increase was anticipated, and that's the reason it is nothing to worry. Only the net interest margin, yes, there is a deterioration of it from 8.74% to 8.48%. Now we'll have to ask the management why this is there is a decline in net interest margin and what will be the way forward. Prima facie, if you look, the numbers are a mixed bag. NII is a miss, but yes, profit numbers are better.
Okay, a miss on NII. Profit slightly better, but overall one would have to say operationally it is a weak quarter, and that's being felt on the stock price as well, which has pretty much gone one-way move up. Other than, of course, the last 1 month, ever since its inclusion in the Nifty, it's really been a one-way ride. Shriram Finance currently 529 in trade as we speak right now. What else is happening in the market? It continues to be that consumption pocket which is looking good. That's perhaps the only hiding space right now. And then ICICI Bank as well. That's also looking good ahead of its numbers tomorrow, holding up 0.5%. ITC, TCS, Titan, these are all names which are just relative outperformers. But Gurmeet, what happens to the performing end of the market? And by performing, I mean before this correction panned out. Your Trent, Polycab, some of the other, those mighty bigwigs which have seen a big fall, even a Havells, for instance.
So I think especially the building material names probably, I think, so if you see Polycab, they had guided for 20,000 crores of top line by 26. They've already done 15,000 crores this year, and there is a quarter to go. So there is 1 year before it, actually meets that, and their margins have actually gone up. It's almost 13.7. I think what's been a drag is the FMEG, which is the fast-moving electrical goods, and that's been a bit of a drag. Although that also the losses have narrowed. But as I said, Aisha, these are valuations. It was trading at about at 7,500 or 60, 70 times earnings, and you're growing at, let's say, 50, 20%. Then obviously there is some price and time correction which happens. So I think, but as I said, it's a high quality stock, and now valuations are again still slightly higher. around 35-40 times, but good growth prospects. They continue to lead market share. So some of them you can add. On dips, trend in my view is still expensive, and the impact of slowdown would be felt a little more. Especially in the category in which Trent operates it, and still in 3-digit multiples. So that I may not add. I may look at some FMCG names which haven't done well for a while now, versus adding Trent there, and look at better consumption plays. Like, for example, the travel and tourism is a consumption play. A lot of marketplaces are a consumption play. I think that's a better place to really add, rather than just only look at few rich names which are still rich post the correction.
Coming in as far as some of these sectors are concerned, but since we're talking about Polycab, let's hear out what the management told us yesterday.
We will continue to grow at a rate which is going to be 1.5x of the industry growth rate, with EBITDA margin of a similar pattern of 11 to 13% cable and wire business. And the FMEG business, the EBITDA margin will expand over the next few years and should be able to achieve 8 to 10% of EBITDA margin in that particular business. Because of a lower base, we believe will continue to grow at a rate which is going to be 2x of the industry growth rate. And EPC is a tactical business. It's very small in the whole scheme of things, but we believe that that business will continue to grow at a decent pace.
Polycab management stock still reeling under pressure, 5.25% down as we speak right now. Laurus Labs, that's looking okay. There's AU Bank as well, which is holding out. And then, of course, FMCG continues to look good, along with Emphasis, which has now climbed up about 3% or so. For the overall market, though, started off this week with pain, and we're ending with pain, 137 points lower, and it's the volatility which is getting a little unnerving. But Gurmeet, I guess this is going to be the same up until maybe the budget, right, which acts as the next trigger, and then of course you'll have the credit policy and so on and so forth.
But the one good thing is people have not much expectations of the budget, and I think our markets have now discounted budget for a very long time. So you're going into budget with low expectation actually is not bad positioning, and the fact that we have corrected. I think broadly what we need to see is the dollar index has to recede back to 105, 106. The bond yields have to slightly soften in US. So this is basically a Trump trade or the US trade playing out. And Aisha, last 10-year returns of the EM pack, if you'd add China 40-45%, is very low single digit in dollar terms. There's some bit of disappointment also. It's basically the broad EM which is selling more. India, obviously, because of valuation and growth slowing down, has taken more of the brunt. So I think it should settle, in my view. So FI holding now is already down to 16% of the market. We were at 22-23% pre-COVID. So technically they have sold a third of India, in terms of percentage holding I'm talking about. So I think, it should settle. I can't put a level to it, but I think our growth has to come back. And I think that is what is in our control. How much will bond yields in US will go? How much will the dollar react? That's something which is beyond our control. But if we can get the bit of economic momentum back through some triggers in the budget, I think we should be good in the medium term.
Let's see whether that works out or not. But I mean, I wouldn't agree completely with the point that we are going with very low expectation, because the expectation is high that there needs to be something to spur consumption, whether it is on the income tax side or some other way to spur consumption. I think that expectation is definitely there. But the market is actually now below the mark of 23,100 as well. The Nifty Bank has taken a dip of almost 250 points. I'm talking that from the flatline level. Of course, from the highs of the day, the fall is much sharper. To the Bank Nifty is showing signs of recovery at this point of time. Nuresh, talk to me about a couple of these charts which are actually perking up. Laurus Labs, which is a result reaction. The numbers just came half an hour ago. 5-star business, which is up 5%, and Amber Enterprises seems that all that pain which was there in the EMS segment is getting over. Would you agree?
So Laurus looks interesting because the stock has gone through a 2-3 year phase of consolidation, and 620 is a resistance which you need to watch out. That was the high back in 2022 a couple of times. So for now, the result reaction is good, but going forward, if it breaks 620 odd levels, that would be a fresh breakout. 5-star business has seen flip-flops between the 630 mark to 800 multiple times. So for now, would be an avoidable space. Same as with Amber Enterprises. We've seen the EMS category take a larger hit. This has held on a little better given the fact that it did not see a parabolic move like Dixon, etc., but still would be a little cautious here.
Gurmeet, great to have you on the show. Aditya, Naresh, we'll let you guys go as well on that note. Winding down week for the week. In fact, it's been quite a painful one, hasn't it? The Nifty itself is closing in at a 7-month low. We've seen a decline for a third consecutive week. Trent, SBI Live, these have been your biggest pain points in the week gone by. But Ashesha is here to wind up how the day has panned out.
Well, absolutely. It turned out to be a weak day for Indian markets. Nifty ending 120 points lower at that 23,080 odd mark, below 23,100. Across the board, several sectors were trading under pressure today. Nifty Bank was also down to 250 points at 48,350 odd mark. In terms of individual losers, we had Dr. Reddy's down 5%, biggest loser on the Nifty 50 index on the back of numbers that it reported, down over 5%. Trent was another loser, down 4.5%. M&M from the auto space was also reeling under pressure, ended the day with a cut of nearly 3%. In terms of gainers from the FMCG sector, we had HUL up 2%, and Eicher Motors was also trading with gains of nearly 2% in today's trading session. In terms of individual sectors, IT sector was the best performing sector in today's trading session. Emphasis, Persistent Systems, Coforge were some of the other gainers from the Nifty IT index. On the losing side, though, Pharma index, apart from Dr. Reddy's, we had Gland Pharma and Natco Pharma under pressure. Nifty Pharma index down over 2%. Gland Pharma and Natco Pharma should also come up for you on the screens. Natco Pharma down 4%. In terms of individual movers and shakers, we had Cyient, which was down a whopping 23% after it reported very weak set of numbers. That stock down 23%. Revenues were up, but margins were impacted. Guidance for FY25 was also lowered, because of which the stock saw the kind of knock we are seeing on the screen. Emphasis, meanwhile, ended the day 3% higher. Revenues were up 0.7%, margins stable at about 15.3%, and the management commentary for the fourth quarter was also quite positive. Emphasis holding up with gains of 3%. AU Small Finance Bank, meanwhile, from the banking sector, also ended the day nearly 2% higher. We had asset quality, which was largely stable. Net interest income up 53%. That stock is ending the day at about 590 odd levels. Granules, meanwhile, from the pharma sector, down 3%. Revenues declined, and some commentary came in with respect to the outlook going forward. Several earnings candidates that were reacting to their numbers, but all in all turned out to be a weak day for the Indian markets. Nifty ending 115 points lower, below that 23,100 odd mark.